Jamie is your homegirl here. I wanted to do a presentation for you about how to buy a house. I get asked a lot of the same questions, and I thought this would be easier to refer to, and hopefully you enjoy it. So today, what we'll be looking at is the benefits of purchasing your own home, the home buying process, and how to create generational wealth using real estate. So why buy? Of course, there's financial stability, like a fixed payment instead of a rent payment that's going to change all the time. Tax advantages, you can talk to your accountant about things that you can write off. Sometimes you can write off interest, or if you're self-employed, you can use your home space. There's lots of different things, and I would definitely talk to a CPA about the advantage of buying versus renting. Freedom to personalize your own space. Of course, everyone wants to paint and decorate and do all the things, but if you rent, that's not always a possibility. Appreciating investment. Instead of paying somebody else's mortgage that is going towards their equity in their home, you can actually pay yourself. By eliminating rent and also putting it into your mortgage, you're going to build equity, and your home is going to appreciate in value, which means it's going to grow in value. So also help you build your credit as long as all of your payments are made on time. This cute little quote down here: some people look for a beautiful place and others make a place beautiful. Just something to think about as you're purchasing your home. So where do you start? The first step to purchasing a home is talking to a loan officer like me. They'll guide you through the process and help you meet all the key people involved in your purchase. Screw it, let's do it, Richard Branson. I love that because a lot of people are just sitting on the fence wondering if they would qualify. And the best way to see what you qualify for is to talk to a loan officer. You can go talk to a bank. You can go talk to an credit union. You can call someone. If you don't know anybody and you can't use me for whatever reason, talk to a realtor and they'll refer you to their favorite loan officer. But first, get pre-approved. It is very important to get pre-approved before you actually start shopping for a home. You do not want to be heartbroken when you go see the dream home and only to realize that you can't qualify for that loan amount. So what's the difference between a pre-approval and a pre-qualification? A pre-approval is a process that includes a credit application as well as income and asset verification and has reviewed by underwriting. So for example, when you work with me, our first step is going to be filling out the application, whether that's online or over the phone. And then I will help you to go over your options and programs that you qualify for based on your credit. And after that, we'll talk about what documentation you need to provide for me to make sure I have everything ready for underwriting. And then we'll put it through an underwriter so that when you go to find a home and it goes through another underwriting system, you won't be declined because there's different levels of underwriting. And so a lot of times things aren't put into an underwriter's view. They're just ran through an automated underwriting system. Sometimes that works just fine, but other times, if there's some questions or red flags or things that we need to overcome, we'll actually have it reviewed by an underwriter that will then see your file and make sure that once you get under contract that all of those items have already been cleared. So it'd be more pending an appraisal and title, clear title, and we'll talk about that later. So a pre-qualification is like if you just talked to a bank and they pulled your credit and they said you're good to go. That is not necessarily the best option because you could get under contract with the house and then not be able to close. And your stuff would be all packed up. Maybe you've already given notice to your landlord and now you have no place to go because you can't get that loan for that home. So make sure that you work with somebody who is reputable and that actually asks you more questions about your goals, gets your documentation, and has a plan for you to get keys at closing. So how do you get pre-approved? The first step is to fill out the credit application. Like I said, we can do this either online or over the phone or in person with your loan officer. Generally, working remote won't meet in person, but there are banks and places like that that you can walk into if that's easiest for you. And the credit application is going to ask you for basic information like your name, address, place of employment. You need to have about 2 years of history for both your employment and also your addresses. Even if you've worked at 10 different places, we will absolutely need to know all of those and the gaps. So think about your start and stop dates, kind of like you're filling out a resume. Then we'll also talk to you about the type of home that you're looking for and what the purchase price is and the loan amount. So it just will depend on the programs that you qualify for. So an initial application, we might be guessing, and then we will change those numbers once we get all of your income verified and your savings and all of those things. So your next step is to answer any additional questions that your loan officer might have. So generally what happens is you fill out the application and then I go back through it and see if there's anything that's missing or if I have additional questions on. And then I'll also ask you for some documentation like your identification, any income documentation, depending on where you work. We'll need pay stubs, W-2s, tax returns, 1099s. If you're retired, you'll need pension. VA, you need to have any benefits, any type of income that you get, there's documentation for. And then bank statements will help us to verify how much money you have for closing. So a lot of times I talk to people about how much money they have in total cash to close. I'm not just asking about your down payment because there's more to go with the loan. Like fees for closing costs and all that. And yes, there's down payment assistance, and yes, there's seller credits, but not always are those things available. So I want to know how much money you have and how much of it you want to spend to make sure that we're all on the same page about what it's going to take to get you into a home. So your next step will pull your credit if we haven't already done that. And then that will show us what your monthly payments are. And that makes a huge impact on what loan programs and purchase price you qualify for. So not just your score, but what your actual minimum payments are. And then after all the steps have been completed, it's time for your application to be reviewed by the automated underwriting system. And like I said, if there's any additional things that need to be reviewed by an actual person, we'll send it to an actual underwriter for review. So as far as loan programs go, I don't want to dive too deep into this because there's always new ones and there's so many things out there. But these are the most common things that I look for when I'm talking to my clients. So a conventional loan is, for people that have great credit, that don't have a low debt to income ratio, which a debt to income ratio means how much money do you have coming in and how much money do you have going out? What's that ratio look like? So a conventional loan is the one that most people are going to look at as far as sellers go and agents go for, the easiest, most, how do I say it? Probably most competitive offer. So just because it's conventional though, doesn't mean that it is actually the best loan option out there. FHA loans, I have a lot of people that are maybe have higher credit scores than conventional, but they need the debt to income ratio to be higher. So on a conventional, you can go up to 50% debt to income ratio. FHA will allow you to go up to 55. And the difference between the two is one is guaranteed and the other is not by the government HUD department. So what we're looking for is Housing and Urban Development, and they're backing this up, which means there's this upfront mortgage insurance premium of 1.75%, and then every month there is a mortgage insurance premium for 0.85%. So it can be a little bit more expensive, but they lower the rates. The rate's going to be lower on FHA, but you're buying it down essentially with that mortgage insurance. Conventional, you don't have mortgage insurance if you put 20% down, but you can go as low as 3% down, and that mortgage insurance will be dependent on your credit score, your down payment, the amount of the loan, where you're living. It's just like a regular insurance premium where there's a lot of factors that go into it. So that is something to think about as we're looking at doing conventional versus FHA. VA, best for veterans. Of course, our veterans have a specific loan program just for them. You do need to qualify. Just because you're in the military doesn't mean you actually qualify for this loan. But I love doing veteran loans, and I'd be happy to see if that is an option for you. And then USDA is best for people who want to live out in rural areas. This is another 0% down loan option, but the property has to qualify, not just you. So it's very low debt to income ratios, and the property has to qualify. So there's a lot of restrictions on this program, but if you fit into it, it is a great program. And then, of course, we have things like down payment assistance, things that we call investment property loans, bank statement loans. There's all different kinds of programs. Like I said, these are the most common ones. And what I do is take your information and figure out which programs are best for you, and then make recommendations, and then you make the choice of which one you want to do. So what goes into your payment then? Because this is a very important thing. I always ask my borrowers, what are you comfortable paying for your monthly payment? Because unlike your rent, you actually have a compound, like basically there's more involved into your payment than just the principal and interest. You also have property taxes, homeowners insurance, mortgage insurance, and maybe HOA dues depending on the property that you're buying. So principal is the amount loaned to you. Interest is the fee you're paying to borrow the money. That part is not going to change. It will always be the same for the term of your loan. Taxes can go up every year. They can also go down, but most likely they go up. Insurance, hazard insurance, it's like having car insurance. It's for your house. That is also a third party. I have no control over that, and it ranges on your credit, the type of property, what all things need to be insured. So we'll help you with an insurance agent on that part. And then mortgage insurance, if you put less than 20% down, or if you're doing a government-sponsored program like VA, FHA, USDA, then there's mortgage insurance on those. VA has an upfront mortgage insurance, but no monthly mortgage insurance. And then FHA and USDA have both an upfront and a monthly mortgage insurance. Conventional, you will be able to see depending on the loan for that, and we'll go over that. And then homeowners association dues are applicable only on specific properties, sometimes like condos or those, we call it a PUD. It's a public development. So depending, like a lot of new construction has an HOA fee. So that's all what's in your payment, and the taxes, insurance, mortgage, those will all be included in your escrow. So every month you make a payment, the principal and interest will go towards the principal and interest, of course, and then your taxes are paid twice a year, and your insurance usually once a year out of your escrow account, as well as your mortgage insurance being paid to the sponsor for that as well. So we help you on the lender helps you on that part, but you don't have to have your taxes and insurance escrowed either. You can pay those yourself. But for a first-time home buyer, I highly suggest having everything wrapped into one, because otherwise you're going to forget to go pay it twice a year. Plus, it's a big bill if you don't save up for it. Okay, so what if you're not ready? What if we've completed this whole entire application and you don't qualify for any programs right at the second? So I created a mortgage readiness program where we're going to set goals based on your personal financial situation and help you overcome whatever obstacles you're facing, including credit restoration. So whether you need to move your credit score up or you need to save some more money to get what you want, we will work on that together, and you'll have a 90-day check-in, and of course you can check in sooner than that, but we will have a plan and make sure that we have SMART goals to achieve your home ownership goals. Absolutely. So once you're pre-approved, it's time to shop. And now that you know how much you'll be able to borrow, it's time to connect with your realtor and start looking at potential homes. Here are some of the things to review with your loan officer before making an offer. So Does the property qualify? A lot of times you qualify, but the property might not qualify. So there's all different kinds of homes out there, and sometimes people like to get super creative, especially depending on their price range. So if it's not just a regular stick-built, home, like a single-family home is what they call it, or even some manufactured homes, they usually need to be double wide versus single wide. Everything is financeable, but it depends on how much you're putting down and what your credit score is as well. So just something to think about, especially if you're using down payment assistance. Is that property going to qualify? And then what's your estimated payment and cash to close? So your cash to close is also going to include your closing costs. So that's why I want to make sure that you have enough money. So what I do with my clients is you show me the house, send me the address, and I will send you a new scenario with your estimated payment based on that house, because taxes are, hooked up to every single home that you send me. So I can actually go and look that up instead of estimating the taxes. I want to actually see what they are, because sometimes they're really high compared to what we estimated, and sometimes they're a lot lower. So it makes a difference on things like debt to income ratio and whether or not you'll qualify with cash to close. And that's why I want you to go over everything with me. And plus, then once you're ready to make the offer, I can call the listing agent and let them know what a great qualified borrower you are. So just something to think about. You can't have everything you want, but you can have all the things that really matter to you. I found a home. My offer was accepted. Let's try that again. I found a house. My offer was accepted. I'm so excited for you. You should be excited too. This is probably the second hardest part of the whole process. So now what? Next steps, we're going to move through the processing stage. So you're under contract, which means you wrote an offer. The offer was accepted on that piece of paper. That's called a contract, purchase and sale agreement. So now we're going to look through all of your documentation that I requested for your pre-approval, make sure it's all up to date. Everything has to be within 30 days of closing. We will go over your disclosures and have you sign them. Everything is done electronically, so you just click, 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 but I want to make sure you understand everything that you're signing, so we'll go over those. And then the earnest money will be delivered to the title company. So this earnest money, it's a check that is going towards, it can come out of your down payment essentially. So you put money like a deposit up front to show the seller that you are serious about this, that you really want this house, and that you are willing to put money in the bank to show that you are good for it, basically. So this earnest money is delivered to the title company. It just sits there until closing, and then you get a credit at closing for that earnest money. So let's say your down payment is $10,000 and you give $1,000 in earnest money, you'll only need $9,000 at closing, besides closing costs and all that stuff. Inspection, this is the property condition report. So this speaks to, if there's anything wrong and what needs to be fixed, and your realtor will work with you on that. And then the appraisal, we'll need to order that. It's a property value report. That is what the bank uses to determine your value of your home and what we can do in as far as a loan on it. And homeowners insurance, again, that is like car insurance, like hazard insurance. So it helps you to make sure that if anything breaks or if your house is broken into or things like that, you're covered. So we'll have you talk to an insurance agent and get a quote. All of those things are then put together, and we will be sending that into underwriting for review. 90% of all millionaires become so through owning real estate. Just want you to remember that, because I know this seems like a lot. It's quite the process, but I will be here to hold your hand and make it easy for you. And someday you might be a millionaire. So speaking of holding your hand, I wanted to go over who's who in this process. There are a ton of people involved because it doesn't take a lot to make this happen. So let's talk about who does what. So first of all, your realtor is your person that is going to help you not only find a home, but negotiate the price, the closing costs, seller credits. They'll help you go over your inspection and see what things that you can ask the seller to fix. They're really there throughout the whole process to facilitate and mediate. and make sure that you're protected. They are your advocate. So don't just think of them as the person that opens the door. They will be your go-to person when it comes to anything dealing with the house or the sellers. And then your loan officer is going to be the one that does all the finances part. So if you have questions about how much money you're going to need, what the seller credit looks like, what earnest money is, anything like that, you'll want to talk to your loan officer. Again, rates, payment, anything that has to do with money, you'll want to talk to your loan officer. Next, we have your title company and your insurance agent. So your title company is the company that helps prepare all the documents for you to sign. They check for title insurance and lender's insurance, and those are the things that make sure your title is clear and that you don't have any pending liens, tax liens, anything like that. Everything's resolved. Also go over any kind of property easements, rules. They'll have everything ready for you to review. And they also help us get you signed at closing and then record the deed with the county. And your insurance agent is the person that you'll want to talk to make sure that your home is covered against any of those things that I mentioned earlier. They can also help you bundle things. So I prefer having a local agent, and I can give you some recommendations. But of course, if you already have renter's insurance, or if you have car insurance that you want to get a quote from your agent for that, that is a great thing to do, because sometimes you can get discounts. So make sure you go ahead and talk to your insurance agent about what homeowners insurance covers and what it looks like. And next, you have your home inspector and your appraiser. So again, your home inspector is really important in your contract. It will give you a date and timeline of how long you have to get your home inspected, and then bring up those issues to the seller so that they can potentially fix them. If your seller decides not to fix them, then that's the time where you are able to back out and get your earnest money deposit back. Again, this is something that your realtor will help you with. They'll review the inspection and help you decide which way to go next. And then once you decide to move forward, we will order your appraisal, and the appraisal will go out and speak to the value of your home. So let's say your purchase price is $500,000, but the appraisal only comes in at $495,000. What does that look like? Who helps you with that? Between your appraiser and I, we will be able to figure that out. Thank goodness we haven't really seen any low appraisals lately. That is the amazing part of our market stabilizing now. So again, things come up, but your realtor and I will be able to help you get through those obstacles. So next will be underwriting, because once your application is complete with all the documents and they're all organized and we've talked to everyone, your underwriter will review everything with a fine-tooth comb. And then they might ask for additional information and documents before giving final approval. So, we try to get as much as we can up front, but then an underwriter will come through and they might have additional questions. So be expecting that. It is, like I said, a process with several stages. And I know that it seemed like you already gave us a lot of documentation, but sometimes the underwriter just needs a little bit more clarification, and that's okay. So clear to close, also known as your final approval from underwriting. Now your numbers are going to be finalized with the title company, so you'll have an exact number of how much money to bring to closing. So this is a question I get a lot, because really we're just estimating up until the point where you get your clear to close. Everything can change the numbers from the date that you close to the insurance agent that you use to the title company, that sort of thing. So once we have all the numbers verified with all those different third parties, we collect all the invoices and we give them to the title company so that we can what's called balance and make sure that everybody has the same numbers. And then you will have an exact number of how much to bring to closing. Usually that is done via wire transfer or a cashier's check. But before you send out a wire, make sure that you've talked to the title company and verified the wire information, because if you get an email asking for a wire, it could be fraud. There is a very good chance that somebody else could get your money and you will be out that down payment and we won't be able to recover it. So make sure before you do a wire that you check with the title company that they did request that information from you. It's tangible, it's solid, it's beautiful, it's artistic from my standpoint. And I just love real estate. This is Donald Trump, the 45th President of the United States of America. Again, I want to make sure that you all know that during this process, even though it can be annoying and frustrating and stressful, it is all very much worth it and will help you build wealth instead of helping someone else build wealth. So once you have signed all of your documents and delivered your funds, the loan will be funded by the lender, the bank, and then the title company will take everything and send it into the county for recording. But the reason I put this on here is because a lot of people think as soon as they sign or as soon as the loan is approved that they don't have to worry about anything, and they might do something that would affect their loan and it could get canceled and you could be homeless. So just want to make sure that everybody knows that your keys are not delivered until after everything's funded and recorded. The little quote on here: owning a home is a keystone of wealth, both financial affluence and emotional security. So let's remember that as we're getting to these final stages. Keystone of wealth. So important do's and don'ts. During the whole process, up until you have keys in your hands, nothing is guaranteed. So don't make any changes that will affect your job, your credit, or your bank account without talking to your loan officer. Don't make any big purchases like a car or furniture or appliances. You need to wait until after the keys are in your hand. Make sure all your payments are made on time. If you're selling your house in order to qualify for a new house, make sure that you're still making that mortgage payment up until the point that you are in the new house, essentially, or that loan is paid off. And keep your money in the bank. Don't spend your down payment. Don't spend your closing cost money. Any money that you have saved up for the house, do not spend it thinking that you can get it back before then. It's not a good idea. And no large cash deposits. If you are depositing cash, you really are going to have to source those funds. So I will need to know exactly where they came from. I will need more bank statements or a bill of sale if you sold something. So if you're going to make a large cash deposit and you need to use that money for the loan, please let me know so that we can make sure that it's sourced and the underwriter will know what that's from. But believe me, if you quit your job, if you pull your credit, if you do any of those things, I will find out and it could affect you closing. So it's just a good idea to keep everything the same for the 30 days that it could take to do this process. Hopefully it will only take 2 weeks. That's why I like to get things done up front. But again, just want to make sure that you understand there are some things that you should and shouldn't do during this process. Buying real estate is not only the best way, the quickest way, the safest way, but the only way to become wealthy. Marshall Field. Now that we have talked about how to get a house, I really want to talk to you about why it is so important, why you should buy a house, why you should not be paying rent, and that is building wealth. So instead of rent, your possibilities are endless. Your loan officer should be your new best friend. Make sure that they are your trusted advisor when it comes to how to best use the equity in your home to create more cash flow. And I know you're probably like, Jamie, I don't even know what equity is. I don't even know what cash flow is. What are you talking about? I just want to let you know that throughout my life, I have bought and sold several homes. It's always benefited me in my cash flow, my finances, how much money I have every month. And the reason it did is because I could save enough money as I could with my appreciating value in my house. So, for example, when I bought my first home, we bought it for about $215,000, and in 3 years we sold it for $315,000, and we netted about $60,000 from that sale. During 3 years, I was paycheck to paycheck, had 4 kids. There's no possible way that I would have been able to save an extra $60,000. So because I was paying mortgage every month instead of rent, I now had this asset that had increased in value, and I was able to use that equity to then go and buy another house. So this is what I'm talking about. When you are spending money every month just to put a roof over your head, you need to think about whether you're giving that to somebody else or if you're investing it in yourself. So even if your mortgage payment is more, even if it's more expensive to be a homeowner, in the long run, it's going to be less expensive and you are going to create more wealth for yourself. So equity is the difference between what your home is worth and what you owe. For example, if your home is worth $400,000 and you owe $200,000, you have $200,000 of home equity. Your home is on average going to appreciate 5 to 10 to 15 to 20% year over year while you continue to pay down the balance of your home, which creates more equity. So what can you do with this home equity? You can use it as a down payment for a new home or investment. Like I said, I sold my house. I took that $60,000. And at the time, we did a VA loan. So I didn't have to put a down payment down, but I was able to pay off a bunch of debt with a higher interest rate. So it created more cash flow in my life. Now, you could also use that without selling your house. There's things like a home equity loan or home equity line of credit that will help you do a debt consolidation. So if you're having a hard time making credit card payments, or you have all these loan payments that are a higher interest rate, you can actually consolidate that into one low payment every month and create more cash flow for yourself. You can also use it for home improvement, fixing up your house, making it more valuable. That's what the equity in your house is for. You can use it for purchasing a vacation home. You can take out the equity of your house and use it to buy another house, but still keep that house that you're in. So either you buy a vacation home, you buy an investment property, or you can rent out the house that you're in and use the equity in it to purchase a new home. And that will help you to climb this ladder of real estate investment property, which is the main goal that I wanted to really reiterate, that it's one thing to have your own home, but then as soon as you can actually move up and be a landlord, this is the opportunity for you to do that. You don't have to sell your house to get a new one. You could actually rent that out, use the equity in it, and then buy another house and then continue to do that same thing over and over until you have so many properties that are paying you that you can retire. For example, if you buy one property a year for the next 10 years, you now have 10 properties that are paying you. And as you pay down those balances, you now have all these assets. So as the loan is being paid down by somebody else, you have an investment that you can capitalize on and use that equity. And pretty soon, as soon as the loan is gone, you will actually have own properties free and clear that you're renting out and being able to create more income off of. So this could be your retirement plan. And all you have to do is pay your bills, essentially. So if that's something that you're interested in, let me know. We'll create this plan for you. The bottom line, investing in real estate is smart because property is tangible. People always have and always will need shelter. This means it's very unlikely that our need for shelter, like buying or renting homes, will ever go away. Kathy Fettke, co-founder and co-CEO of Real Wealth. Again, I want to make sure that you're not only in your own home and not paying rent anymore, but you are creating generational wealth. So when you're ready to do that, please let me know. We will create your plan. Thanks so much for listening. My name is Jamie Nettles. I'm your homegirl. My information will be in the link below, and I hope to hear from you soon.